activist investors are circling around PepsiCo because PepsiCo is really two companies, Pepsi Beverages and Frito-Lay. Frito-Lay is the Coca-Cola of snacks.
Today, we'll talk about whether or not that means there could be a lot more upside for Pepsi stock or not. And at the end, stay tuned. We also did a 3-minute drill on Warby Parker today on Altimetry Authority.
Let's talk earnings and
GAAP
favorite pastimes.
So let me just say,
Wall Street
Index.
2.5x
because their compensation goes up.
Wall Street's wrong again.
You know, nobody thinks, Joel, of Elliott as being friendly. Anybody who knows Elliott, right, for context, everybody, one of the greatest activist investors in the world in terms of what Singer has done, goes after, foreign nations, steals boats from Argentina to make them pay back loans, finds all these obscure things. And yet, everybody, right, Elliott has recently, the activist investor, has recently gone after Pepsi. And they've gone after Pepsi to say, hey, we think that there should be some change. But Joel, for some reason, they're being overly nice to Pepsi when they're doing it. And I think that what we're going to talk about is a reason why, really, if people get a little deeper, we can understand what Elliott's looking at. And also why a lot of investors are saying maybe Elliott should be a bit more aggressive because there's a lot of value to unlock here. You want to take everybody through what we're seeing in terms of what where Pepsi has been?
So Pepsi has been losing shareholder value for quite some time now, for a while. And one of the interesting things is Pepsi is really two companies. And you could argue the two companies, Pepsi is the Coca-Cola of today, and part of Pepsi is the Coca-Cola of, call it 40 years ago. So the Coca-Cola story was, for decades and decades, Coca-Cola, big brand, wonderful, consumer awareness, and it was still getting a low 8% return on assets for decades. 8%, despite everyone knowing who Coke was for a long, long time. Roberto Goizueta came in, and there's a business school named after him, the first CEO to become a billionaire as a CEO the first time. And Goizueta said, the problem with Coke isn't its branding and its marketing. The problem is its assets aren't being run efficiently. And he took an 8% return, which is around, actually below the U.S. corporate average today, and he took it to something like a 30 or 40% return on assets, where for every dollar, Coke was knocking out a 30 to 40% return on assets that he took from 8. And he did that through efficiency, not through we need more brand awareness. When we look at Pepsi, Frito-Lay, because Frito-Lay is buried inside Pepsi, Frito-Lay is the Coca-Cola of chip companies with 30 to 40% return on assets. It's amazing. Whereas Pepsi, the beverage company, still looks like the old Coke, the Coke Classic, if you will, still getting an 8% return. And so what we're thinking is, for whatever reason, people inside Pepsi have focused so much on Frito-Lay on snacks and has never done to Pepsi Beverage what Roberto Goizueta did to Coke, and why can't they? And so if Elliott comes in, maybe they can split up Pepsi, and maybe you can get a Roberto Goizueta type CEO who understands it to go into Pepsi and turn that company from 8% to 40% and unlock a massive amount of value and still have Frito-Lay humming along doing fantastic. Somewhere, something is keeping Pepsi Beverages down inside PepsiCo.
Yeah, exactly. And so, Joel, let's take everybody through just how it is that Pepsi clearly has a performance dislocation versus Coke. Let's look at the numbers.
So when you look at the as reported, the GAAP accounting numbers, which nobody with their salt would ever rely on, man, I was just teaching an undergrad finance program. I was teaching an undergrad finance program, and even the book said, in like the basic undergrad finance book said, don't trust accounting profits. And yet that's all you hear is the accounting calculation of profits on CNBC and Bloomberg and the Wall Street Journal every day. So we don't, of course, we do what the greatest investors do. We convert from GAAP accounting to uniform accounting. And on uniform accounting, you find, oh, wait a second, Pepsi's nowhere near as bad as the as-reported numbers would suggest. It actually blended together, Frito-Lay and Pepsi Beverage Company is somewhere to be around maybe a 18 to 22% return on asset company. That's the uniform accounting number, right? Now, at 18 to 22%, what people are saying on Wall Street, the actual analyst forecast suggests that those returns are going to go back to some lows that we haven't seen for even 5 years, maybe back to 10 years ago. And those returns are going to drop to those levels, meaning the Pepsi Beverage Company is going to pull down the otherwise really high Frito-Lay profits and bring down PepsiCo as a whole. That's what the analysts are expecting. What the stock market's expecting.
Just really quick before we go to what the stock market's expecting, I mean, Joel, I think we've seen this pattern pop up for a lot of the consumer staples companies, everybody, for context, that for a lot of them, the expectation is that 2025 is going to be a dip down because of a mix of a weaker consumer, tariff issues, any number of issues. But everybody's basically saying that return on assets are going to rebound and be average for 26. But now, Joel, to your point, what is the market pricing in?
Now, the market's pricing in that someone is going to get smart at Pepsi and start to figure things out, and maybe get Pepsi Beverages to start looking like Coca-Cola, which is a beverage company, or said another way, to get Pepsi Beverages to look more like Frito-Lay, the snack company buried inside PepsiCo, or at least get returns back up to some level of average from 2022 to 2023, right? And that from this dip in 25.
Right.
That's
so everybody, if you
valuation.
look at that. And so if you look at that, right, to Joel's point, what the saying is at a $200 billion valuation, the market is expecting Pepsi to get to 2024 return on assets, a little bit above normal, but basically above normal. So you would look at that and you might say, yeah, why is Elliott going after this company? Because that looks like the market already understands that Pepsi is going to improve itself. Well, let's actually talk and dig into some comparables that we can give to the idea of Pepsi being really both Coca-Cola and then Frito-Lay's, Pepsi, right? Pepsi Beverage and Frito-Lay's. Well, there's public company comps for both. Of course, we know Coca-Cola, right? Coca-Cola is easy to look up. If you look at Coca-Cola, their return on assets are pretty consistently around 50 to 60%. And Wall Street is expecting those to maintain. So when you think, right, so this is the idea is, and Joel, right, is could Pepsi Beverage look more like Coca-Cola, in which case everybody, why couldn't it?
Why
and
not?
If it could, right, well, hold on. Then, again, let's go back, right? 20% return on assets is what the market's pricing in. But Coca-Cola, if it could improve Pepsi to look like Coca-Cola, you could be looking at a 50% return on assets because let's look at a pure play comp to Frito-Lay's, which Mondelez is snack food just like Frito-Lay's, right? It's a publicly available Frito-Lay's comp. And they're around 30 to 35% return on assets. And so you think, and this is the whole entire point is, worst case scenario, Frito-Lay's probably already looks like Mondelez. It probably looks somewhere between Mondelez and Coca-Cola. And if we can make Pepsi look the same way, well, this idea that we're only going to have Pepsi have return on assets that are around 20%, totally off base. And this is what Elliott is seeing. And this is why Elliott is trying to get active on Pepsi. Because they think that if they could unlock this, and to your point, Joel, find their own Roberto Goizueta to run Pepsi while letting Frito-Lay's just be Frito-Lay's, they could create a tremendous amount of value on this business. So
massive. Yeah, I mean, what you're talking about is, I mean, think about what Coca-Cola did under Goizueta when it went from 8% to 40+% return under his watch. Not by focusing on coupons and promotions and commercials and brands, but focusing on super efficient value chains and production and what have you. That seems what Pepsi Beverages has not yet gotten, and that's why the opportunity is big. Is that break out Frito-Lay and unlock that 30-40+% return on assets that Frito-Lay has got, and Pepsi's pulling it down, beverages, and then take Pepsi Beverages and put in some good measure like Coca-Cola did, and you may be talking about doubling or tripling the value of the two companies separately versus when they're stuck together the way they are right now.
So interesting one, everybody, to watch for, because if Elliott actually starts to really turn the screws and that unlock happens, there might be something there. But everybody, before we wrap, we did get a request from one of our viewers to do a 3-minute drill on Warby Parker. Everybody, just context for what a 3-minute drill is. And the 3-minute drill is Joel and I just run through. Let's look at what uniform accounting says. Does this company look up, sideways, or down in terms of do we think it could be interesting or not based on a valuation perspective? If you have a company, by the way, that you want to see us do a 3-minute drill in, drop it into the comments at the below this video, and we will absolutely jump into it. So
think of us as, so when we do this, think of us as bookmakers, right? We're setting the line. What is the embedded expectations of the current price? And then we'll comment on that. But we got to set the line first. Anybody can just say one team will win or another team will win. But let's set the line of what Warby Parker's built in at current valuation, and then we talk about whether or not that looks low or high.
Exactly. And so for everybody, if you don't know Warby Parker, the important thing is they basically are a direct-to-consumer brand for glasses. right, to basically be able to make it a more economical way to do it. And this, Joel, one of the things that is interesting that you highlighted while we were looking at this is there is a reason why you might want to pay more attention to this than the as-reported metrics reflect.
As reported ROA under GAAP accounting, which nobody worth their salt would ever rely on GAAP earnings numbers, nor on a GAAP priced earnings number. If the earnings number is wrong, the PE is not wrong. But anyway, and it shows a negative return on assets, when in reality, using uniform accounting, where you handle things like R&D and whatever else, yes, they had a few bad years. They had a few bad years.
They're a
but when you look
startup,
at what they've
did.
done, right? But they're recovering from those early bad years, being an earlier stage company, and you see they're in positive territory. So they are generating positive returns. It doesn't look that way under GAAP accounting because GAAP horribly punishes, just like it did Tesla, just like it's done every earlier stage company. It punishes them in the early years, and sometimes you don't see the inflection early enough because that accounting punishment, the way R&D is treated, the way leases are treated, the way stock options are treated, I could go on and on. The way goodwill is amortized versus the way it used to be. You put all those things on it, it can make a company look a lot worse than it really is, and that's the case with Warby Parker. So in reality, this company has flipped to being a positive, solid business. Now, when you focus just on that, what does Wall Street analysts think? Wall Street analysts are like, oh man, this is going to continue. This is going to get even more positive, not just back to like a 5, 6, 7% break even, but they're going to hit U.S. corporate averages of around 12 and maybe get a little bit higher than even U.S. corporate average, maybe 13, 14%. So that's a reasonable thing to say, is that a startup company builds itself, does well, and gets to U.S. corporate average. Now, what is the line? At this price, right, at a market cap of $3+ billion, at a stock price of $25, $26, you need the ROA to skyrocket to a 35% return. Now, that's the line. So if you say you want to buy the stock, I assume you're not going to buy a stock because you think it is 5% upside or 10% upside. You want that. You just buy the stock market. If you want to just buy the S&P 500, if you're saying, no, this is going to beat the S&P 500, so you want 30, 40, 50, 60% upside, some margin of error, that means you need these returns to skyrocket beyond 40 to 45%. So you're saying this has got to be the Coca-Cola of eyeglassware. It cannot be the Pepsi Beverages of eyeglassware, meaning well-known consumer brand isn't enough to do it. They got to be the peak of efficiency in operations, in their value chain and everything for you to want to buy the stock. Now, I'm not saying that's not possible, but that's a tall statement. That's a tall order. I don't know if that's achievable. It feels like a very high risk relative to reward, because the market seems to already know that this company is out of the doldrums of negative returns and is already pricing uniform returns in to skyrocket.
Yeah, and everybody, for context here, so like Luxottica, which is used to be public, they got bought out by private equity, Italian maker, what basically owns Ray-Bans and every single other kind of glasses that you can think of a name for. Their return on assets at peak was like 20 to 25%. And if you look at even the direct-to-consumer companies for consumer land, for brands like this, you rarely see it push above 25 to 30%. I think, Joel, you and I would both agree, this is probably one that doesn't have a bunch of juice to go a lot higher from here. That doesn't mean it has to go down because, look, when you've got an earnings ramp like they've got going on right here, that company is not a company that's likely to break down because of the fact that the earnings ramp is happening. But I think that you got a lot more juice beyond, a little bit of earnings growth-based juice here. Probably not there, everybody.
I wouldn't even think of shorting the stock. I wouldn't short the stock just because we're not saying it's expensive. We're simply saying there is a lot built into what this company has to do, and maybe they can do it. But if you want 50 to 100% upside beyond that, they're going to have to be, a 60% return on assets?
Yeah,
right?
exactly.
They're going to have to be at some levels that rival almost any industry's best returns, like a AI company or a tech company or something. I don't know if this company has that level of chops in it. Maybe, but I probably find other cooler places, right, to spend my time. Again, not knocking what the company's doing. Fantastic business. Problem is it's kind of priced in.
Exactly. So everybody, if you want to see a 3-minute drill on a company that you're interested in, again, drop it in the comments below and we will cover it one of our next episodes. And if you enjoyed this, hit the like and subscribe button. And that's this episode of Altimetry Authority. Thanks, everybody.